Hey everyone, so in this video we'll be learning about our first method of depreciation, and that is straight line method. So straight line method is also called fixed installment method, right? But the term that is usually used in exams is straight line method. Now why it is called straight line or fixed installment method is because the depreciation that is charged every year for a particular asset is same till its useful life, right? So for instance, if an asset has a useful life of 5 years, an estimated useful life of 5 years, then for 5 years the depreciation that the business will be recording in its income statement will be the same amount, the same value, right? Of course it will vary according to the policy of the business, right? That is, if the policy is a monthly basis, that is charging monthly basis of depreciation, then it will vary, right? Especially in the first and in the last year of that non-current asset, or if the policy is a full year policy. We will be learning about these policies in detail in the future videos inshallah, but right now what you need to remember is that the depreciation that is charged under straight line method is same, right, for its useful life. Now you might be wondering that why is that so, that how is the depreciation same every year? So this is because the depreciation that is charged, or the depreciation that is calculated using straight line method, is calculated on the cost of the non-current asset, right? What is the cost? Cost is the purchase price or the value that the business pays when it is buying that non-current asset, right? Now since the cost is same, the depreciation charge on the cost will also be same. So that is why the depreciation under straight line method is same every year. Now let's understand few formulas that we will be using while calculating depreciation under straight line method, and this will depend upon the information given to us in the question, and according to that information we will be using any of these formulas. So the first formula that can be used while calculating depreciation under straight line method is cost multiplied by the percentage rate, right? So for instance, if I buy a non-current asset and it has a cost of 70,000, and the business policy is to charge depreciation under straight line method at the rate of 10% every year, right? So how will I calculate depreciation? I will multiply 10%, that is the rate of depreciation under straight line method, with its cost, right? So this will give me a depreciation charge of 7,000 every year till its useful life, right? So if we are given with the cost and the percentage rate, then we will be using this formula to calculate depreciation under straight line method, right? So this is the first method. And now let's move to the second method. This says that if you are given the cost and the estimated residual value of the non-current asset. What is estimated residual value? I'll be coming to that in a while. But right now, what is the formula? Cost minus estimated residual value divided by the estimated useful life. So if these terms, the amounts for these terms is given to us, then we will be using this formula to calculate depreciation every year for that non-current asset. Now, what is the residual value of an asset? So residual value is that value that the business thinks, or the business is assuming, that is why it says estimated, right? So this is the value which the business estimates that it might receive, or you can say that it might recover from the sale or from the disposal of that non-current asset at the end of its useful life. For instance, I buy a non-current asset, and in the same year, that is the purchase year, I am assuming that I will be selling it for, let's say, 8,000 at the end of its useful life of, let's say, 8 years, right? So this is the value I think that I might recover from this non-current asset by selling it at the end of its useful life. So this value will be called my estimated residual value. Now why is this estimated residual value subtracted from the cost while calculating depreciation? This is because since I will be recovering, or I will be receiving it at the end of its useful life, this is the value that is still there for that non-current asset, or the asset is still worth of this value after it has been fully depreciated by using it in the business. That is why there is no need to charge depreciation on this amount, because this will be recovered. Right now I am assuming that I might be recovering it. That is why it is first subtracted from the cost, and then we divide it by the number of years, that is the estimated useful life of that non-current asset, in order to calculate depreciation for the year. What you also need to remember about residual value is that residual value is also called the scrap value or the salvage value of your non-current asset, right? The value can be given to you in using any of these terms: scrap value, residual value, or salvage value, right? So again, what is the formula? Cost less the estimated residual value divided by the estimated useful life. Then we'll have depreciation for the year. Right, so we are done with two formulas. Let's move to our last formula, and that is very simple again. This says that if you are not given with the scrap value, for instance, if there is no scrap value in the question, that is, if I am assuming that at the end of its useful life I will be recovering nothing from the sale of that asset, not at all, I won't be receiving anything from the sale of that asset, so then it will have a scrap value of 0. Right. So, if no scrap value is given to you in the question, then simply just use the formula cost divided by the estimated useful life of that non-current asset. So, this is the third formula, that is if there is no residual value in the question. Let's revise it. The first formula is cost multiplied by percentage rate given to us in the question. Second, cost less estimated scrap value divided by the estimated useful life of that non-current asset. And thirdly, if there is no residual value, then just cost divided by the estimated useful life. Now, one more thing that you also need to remember about straight line method is that straight line method is usually used for those assets that are expected to give the same amount, or let's say the equal amount of benefit till their estimated useful life. Right. Now, for instance, if the business assumes, right, just assuming that they will be getting the benefits, equal benefits every year from certain non-current assets, right. Now, since the benefits are same every year, they should charge a cost, or let's say an expense, against those benefits earned every year in the same way, right. Now, since the benefits are same, expenses should also be same, and the only way we can do that for the depreciation of on those non-current assets is through if we are charging the depreciation using the straight line method, because the depreciation under this method is also same because it is applied on the cost, right. So, few examples of such assets could be buildings, fixtures and fittings, office furniture, etc. But again, if other assets are given to you in the question and the question asks you to apply straight line method, then you have to do that only, right. But these are few of the examples on which usually straight line method is used to charge to calculate depreciation, because these assets are expected to give the same amount of benefit every year, right. So, we are done with the background of straight line method, or let's say that how can we calculate in various ways depreciation using the straight line method, right. Now, this is all for this video. In the next video, we will be solving some example questions in which we will be required to use the straight line method of depreciation to calculate depreciation every year, right. So, see you in the next video.